Hello everyone. The goal of this video is going to be getting you long-term investing confidently. There's going to be a lot more videos on the topic of long-term investing coming up soon. In this video we are going to cover dividends, drip investing, and dollar cost averaging. As a quick disclaimer, I'm not a financial advisor. My experience is from my own experience of being in the markets for about 2 years. When I first started trading, I was losing a lot of money, and what I had to do was I had to take a few months to do my research, educate myself, and actually learn how to trade. Since then, I have been able to turn $4,000 into $15,000 worth of profits. Here's my Webull account. There's $12,000 worth of profits right there. And on my Robinhood account, I've actually fully recovered from my losses. You can see where I stopped trading, and I've made some very good trades. One of these trades, though, it was one of the trades during the GameStop mania. I guess it's still happening. I was holding some Nokia calls. I had actually done research on Nokia, and I actually didn't buy Nokia because everyone else was buying it. Those calls were dated for January 2022. So I got lucky on that one, and that netted me a $1,000 profit. I say lucky because I didn't expect to make the profit so soon. I had those calls dated all the way till January 2022. However, Nokia benefited for one of the days during that GameStop mania, so I went ahead and sold those calls for an insane profit. I'm sure some of y'all have seen that post I made last week on my Snapchat story. Anyway, let's get back into the video. So, what is dividends? Some companies will pay out dividends. The money for these dividends comes from their balance sheet, and this is kind of like the company sort of profit sharing with its investors. Not every company offers dividends. In reality, dividends are actually becoming less and less popular because a lot of the companies that are dominating the market right now are tech companies, and a lot of companies that are just focused on growth right now. Maybe later they'll offer dividends. However, anyway, there are some companies that offer dividends, and it's important to have some dividend companies in your long-term account. So just as an idea, Walmart, 3M, for me, I have Innovative Industrial Properties as one of my main dividend stocks. And what this does is this creates free cash flow. And when you reinvest these dividends, which is called drip investing, when you get that small amount of dividends and it reinvests into your account, this can be very, very good for your long-term account, which I'm going to go to the dividend calculator, which you saw in my last video. Quick plug before I go on any further with the video. Since we're going to be using M1 Finance, or I suggest you use M1 Finance for long-term investing, that link is going to be in the description to sign up. Click that link, deposit $100, and you'll have $30 free. Once you've let that money sit in that account, you'll have $30 for free. So go ahead and use that link if you'd like some free money. Anyway, what dividends are, let's look at the growth they can do. So let's say that you have 2% dividend yield for your account, and the annual appreciation for that account is 10%. So this is the 10% that the S&P 500 will usually return. And let's say that you do not reinvest these dividends, you would have $115,000. That's a great ending balance. You put in your money, you put in around $2,000 every year on average over 20 years. That's a good amount of money to have saved up at age 40. Hope more is always better, which you'll see. If you do reinvest those dividends, then you have, in this case, almost $30,000 more in your pocket. So reinvesting those dividends are very important because when you receive a dividend and you reinvest those dividends, you actually get dividends on your dividends. So 2% of your dividends that you just got paid will become dividends in the future, and that just keeps snowballing, and eventually you have a good amount of money piled up in that account, and you're just generating massive dividend payments after like 20 years. So since you're young, hopefully you're young, you're watching this, get started early. Even if you can only put in $10-$20 a month. what's really important is if you just get started. I know this says $2,000 annual. Hopefully, if you get a stable job in the future, you already have a stable job, you have more money, you can put in more than that annually. However, I'm just saying $2,000 annually because maybe you're not able to put in not nearly that amount of money now. However, maybe in the future you are able to put that amount of money or more. Either way, hopefully you save those dividends and reinvest those dividends into your account, and you're able to generate a lot more money. The reason I like M1 Finance is because it takes, I have my account set up so any money over $25 gets reinvested. So once my cash balance goes over $25, that money gets invested. So I have weekly deposits, and that money gets spread out between the stocks that I've chosen in my long-term account. So I have 10% of those weekly payments going to, actually, I think it's the actual target. Okay, so the target is 11%. I might need to lower that. But right now I have 11% of that going into innovative industrial properties, and I'm getting a 2.12% as dividends. These dividends are paid quarterly. There are 3 quarters, not three, there are 4 quarters in the stock market, and these quarters are about 3 months. So January, February, March is a quarter, April, May, June is the next quarter, and so on. It's pretty easy to understand how quarters work. Companies also release earnings each quarter, and they'll announce their dividend date in each quarter. And so by that date, that's the date that you need to have money in the stock if you expect to get a dividend payment for that quarter. And the last thing we're going to talk about is dollar cost averaging. What dollar cost averaging is of course, getting an average price on the stock that you're trying to buy. So let's just, for an example, let's say Walmart is trading at $150, and instead of investing weekly, you just go ahead and take, $500 and buy up a ton of Walmart. What if Walmart goes down throughout the next year? I think Walmart's a good long-term investment, but what if Walmart goes down over the year and they don't have a good year? Since you bought all the way at 140, you're going to have to sit and look at that loss in your account for a while. Instead, if you would have just made weekly deposits, monthly deposits, or even daily deposits, and that money was split up so that a little bit of that money goes to the stock, each time you buy, you're buying at whatever price the stock is at. So therefore, you're catching the average price of the stock instead of just putting all of your money in the stock at one price. Instead, if you dollar cost average, you're able to limit your risk. In my case, even though IIPR is at $208, I made a $10 automatic deposit into my account today, and $1 went to IIPR at the price of $208. However, my average share price is $162 because I've been slowly buying this entire time. This value graph here just shows the amount of money I have in the stock. It's not a representation of the price of the stock, but you'll get that once you download the app. So that's covering dollar cost averaging, that's covering dividends, and that's covering drip investing. If you have any other questions, go ahead and leave that in the comments. In the future, I will of course talk about day trading. However, first I need to go ahead and get some basic long-term investing ideas to you, so that first, before you start trading and trying to trade, you at least have a long-term account going. I think everyone needs to have a long-term account, especially when you're young. The dividend calculator makes that very clear. The more years you have for those dividends and that 10% return or more to just compound and pile up, the more money you'll have at a later date. All right, guys. I'll see y'all later.